There were two big stories in the stock market last week. One, the CPI report came out showing that prices are moderating. The implication of this is that the Fed will not be as aggressive in raising interest rates in their December meeting, and hence the market and the economy will not crash as expected. So this is an assumption. This may be true, but there are a lot of assumptions built into that position. The second thing that I'll cover is that was a big news last week was that the cryptocurrency exchange FTX filed for bankruptcy. This left investors with huge losses and sent the crypto markets further into the red. Hi, I'm Ben Reppond. Today is November 15, 2022. Welcome to my YouTube broadcast. I will let you hear from those who are closer to each of these stories. I'll first begin with an interview that Carl Quintanilla does with Art Cashin. Art Cashin is the manager of floor operations for UBS and has been in or on the New York Stock Exchange floor for about 60 years. 60 years. And so he's, it's interesting when you listen to him, and I've listened to him for years, and he's always very measured, very considered, and he's thinking every day that something is going on in the stock market, particularly if there's big news, good or bad, he's thinking about it, thinking about what are the implications of this, what does this mean for investors, what does it mean for things coming in the future, and connecting some dots. So I appreciate CNBC and Carl Quintanilla reaching out to him and getting his perspective, which comes with a lot of experience and good judgment. So listen to this from Carl Quintanilla and Art Cashin.
Now, we talked a lot during the summer about your craving for big downside volume day, big spike in the VIX, sort of classic signals of a bottom. Are you getting the sense that maybe the bottom could have come and we wouldn't have gotten those things?
I still think we probably will go back and retest the lows. I'm certainly, I mean, yesterday's rally was borderline miraculous. I mean, they kept moving up. There was no retracement. There was no pause and look back. But not to rain on the parade, you have to remember that rallies in bear markets are short, sharp, and die in low volume. So I'm going to keep watching the VIX. If it moves down to around 20 or so, then I'm going to see it. So far this year, whenever it's gotten down around 20, it's been like an electric shock. And the rally that was going on when the VIX dipped down there ended and rolled over. So that, to me, that'll still be a key indicator.
Next, Scott Wapner interviews Steve Weiss and Scott Minerd. And in light of the fact that toward the end of the week, the stock market rallied following the news of the announcement that the CPI rate was less than expected. So they, Steve Weiss and Scott Minerd put this in perspective and talk about the context of a longer-term secular bear market and what this represents inside of that bigger picture. So again, like Art Cashin, giving perspective and context to the current state of events. So I think you'll find this helpful.
Get to another very well-known investor in a minute who thinks stocks can run. You must as well, based on the activity that you have today, which I see is rather substantial. You bought more Microsoft, Honeywell, Goldman, Bank of America, added Morgan Stanley, the XLF, Chevron, the Qs, United, and on and on.
And I added GXO.
More bullish?
Oh. Well, I look, my view has not changed very much. I still think that earnings is going to come down significantly, far below what consensus is, which is 220 to 235. I'm looking at 200 next year. But you've got this window right now. It's a seasonal window. So look, PPI will come out Monday. I don't think, even if it's more than consensus, I think the market will look past it on a knee-jerk reaction. But then we come to Powell in the middle of December. I think December 13th is when we get decisions.
CPI right before that.
Right. PPI is this Monday.
Yeah, no, I know. The next
exactly.
CPI comes out literally the day before the Fed decision.
Yeah, absolutely. And, Powell's going to put the kibosh in the market. So, look, my base case had been 50 basis points next meeting. I don't think that changes. But this is not what he wants to see. This is, whether it's the bond market or whether it's the equity market, they are monetary tools. And right now, what you're seeing is some unraveling of what the Fed has done because of what bonds have done. Not today, because they're closed, as you mentioned. So that's the concern. And the other issue is, if the market does decide to keep going past that Fed meeting, and I think there's a chance that it could until we get earnings, that keep in mind that at that point they're buying deeper into a bear market, and I think it continues. But that base case that inflation has peaked, and that base case that the wolves have come out saying they're going to pivot. They're going to pivot.
Yeah, I know,
again.
but that's fine. But your overall view doesn't have to change but your shorter term view can change. You don't need to re-articulate why all the reasons that you're big picture negative. You bought all these stocks. Obviously, you think the market can run for a decent amount of time, as does another person who's been negative, looking for a 20% decline in stocks. That's Scott Minerd. He was with me yesterday in overtime. I mean, he said this.
I think the bear market is still solidly intact. I see this as, a relief rally. I'm still of the opinion, look, I always say I like for the data to talk to me rather than for me to try to, to predict the data. But so far, I would just ride the seasonals here. Things are still, fairly well valued, and inflation is coming down. And I think we are prone to more downside surprises on inflation, which would be good for the bond market.
Next, Mike Wilson, the chief equity strategist for Morgan Stanley, is being interviewed by Bloomberg's Jonathan Farrow, asking his take on the market. And not unlike Scott Minerd and Steve Weiss, he views any kind of rally at this point as short-term reaction or kind of a relief rally, blowing off some steam, and that it will die on weak volume and then collapse and continue on as part of the longer-term secular bear market. So take a listen to Mike Wilson.
Mike, can we just start with this mess playing out in crypto all around us with things like FTX? What does it mean to you, Mike, looking at the broader equity market?
Yeah, I mean, look, this is financial contagion risk. I think part of the reason we rallied so much yesterday, quite frankly, is because I think there was people putting crash protection on into what was, an event that had been obviously previewed for several weeks. I mean, the CPI release was the event. It was actually the fourth event in 2 weeks that we've been focused on, that we've been kind of waiting for to finally get this rally in bonds, John, that we've been talking about, it seems like, for months. And, the four events were the Fed itself last week, which, remained hawkish, but, kind of opened the door to a step down in terms of pace of rate hikes. And then, of course, we had the strong non-farm payroll number. Then we had the election, which I think will lead to a mixed government at the congressional level. Maybe not a red wave, but enough to block, crazy fiscal next year. And then we got the CPI, which really confirmed a view we've had for a while, as you know, which is that inflation has peaked and it's probably going to come down pretty quickly. So all that leads up to what we think was the fattest pitch in the market, which was going long duration. And that will lead to the next leg of the equity rally, because as rates come down, what I think will happen is, we saw this yesterday, so it's good confirmation, the NASDAQ, which has been the laggard in this rally so far, can now catch up. And that's what happened yesterday. I mean, obviously the whole market was up, but it was led by, these longer duration growth assets, and that's tied directly to the move in rate. So that's basically our call to a T. The tricky part now is going to figure out, okay, when is it over? I don't think it's over yet. I mean, clearly this overhang from crypto is not constructive, but I think what it did yesterday, I mean, we saw a big retail selling yesterday. So it's amazing to me is that we're having this event, which is a little bit scary, and yet the market was up, 6, 7, 8%, depending on which one you're looking at, which tells me that people were just out of position. So probably further to go, I would say through Thanksgiving, maybe even into early December. We'll, us, John, we'll manage this tightly. We'll be disciplined, but I don't think the rally's over at this point.
Mike.
So it's interesting at the end, he said that Morgan Stanley, has their controls set tightly and they are ready to get out of the market when this runs out of steam. So I would echo that because we have the same thing. We have our controls set tightly, and any kind of a move down or any kind of indication that risk is coming into the market, we will be out of the market. Next, I want to play for you the podcast from David McIlvaney, McIlvaney Weekly Commentary. This is just a small piece from it. But again, he gives context to the market, the valuation in the market in relation to gold. Now, he goes back all the way back into the 1800s to use Charles Dow and Ed Jones, who developed the Dow Jones Industrial Average, and the ratio and the history of that ratio and what it means. Interesting context and a different perspective. So I thought I'd play this piece for you from David McIlvaney.
And at the time, it was worth 1 ounce of gold, $20. And over the next few years, a couple of decades, till 1929, the Dow rose to 20 ounces of gold. And then there was the reversal. That actually is reminding me of where we are today.
That's right. So you get an index, which was once 10 companies, now 30. And it was a proxy for the markets. Still is.
Right.
And you're right. As things continue to grow in the post-World War I period, we got through the roaring 20s to the market peak in 1929.
That fateful year.
You could exchange your shares in the short list of companies for a few ounces of gold. In fact, it was about 19 ounces of gold, 18 and change. Then the market crashed. Stocks went into free fall. Gold obviously is a security, and people clamoring for what at that point was still just cash, really. Moving to cash was moving into gold. It goes from an 18 or 19 to 1 ratio down to 1 to 1.
Right.
1 to 1 was the ratio. The Dow Jones Industrial Average had the same value as 1 ounce of gold.
And could that happen again? Because we're at 19 to 1 now, aren't we?
We are. We're 19.3 as of this morning. And we've been as high as 43 to 1 going back to the year 2000. But here we are at close to 20 to 1.
You wonder when that happens. And it's not going to happen overnight. But, I think of the tantrum that occurred a few years ago when the market expects one thing and gets another. This week, we saw the same type of thing, didn't we? There was elation after Powell talked
for about
publicly.
20 minutes.
Yeah, and then Powell gave an interview afterwards, and he just poured water on it, didn't he?
Party pooper. Well, his decision to raise rates 75 basis points was not a surprise, but his assertive stance in the Q&A afterwards signaled to the market that a pivot to looser policy was not to be expected anytime soon.
There's your tantrum.
Yep. Tantrums ensued, which may have marked the end of a very short and sharp rally. And time will tell. But bearishness, it's very interesting because we got very bearish very quickly. And then all of a sudden, as we head into this week, it's not so bearish. We look at a variety of indicators suggesting that pressure, the internal credit market pressures, are actually not on the boil. So we've got an election, significant data releases this week. And so actually a bit of confusion in terms of discerning the short-term trends. That can be a challenge.
We have a tendency sometimes to look at the nominal rate, what we see in numbers, but actually the real rate of interest.
Since this relates to the market and and kind of foreshadows the coming recession. It's been correct for the last 4 or 5 times in the last 50 years as being an indicator of a coming recession, and that is what's called the inverted yield curve. This takes the short-term rates. The short-term rates are higher than the long-term rates. That makes no sense, except that in an environment like this, people are willing or want a higher premium for short-term treasuries and are willing to take less of a rate long-term. It's just an interesting twist. And so the chart I'm showing now is that. It's the ratio, it's charting the ratio of the 10-year to the 3-month. So if this goes negative or as it goes down, that favors the short-term rates, which if it goes below the zero line, then that's an indication goes negative. That's an indication that within the next, I believe it's 6 to 12 months or so, there will be a recession. Of course, I think we're in a recession based on the way they've defined it in the past, but let's say more of a full-on, deeper recession. You've undoubtedly picked up that Sam Bankman-Fried is the owner of FTX, and FTX filed for bankruptcy this past week, and it was a major collapse as it related to the cryptocurrency world. You know from my former broadcast that I'm not a fan of crypto. I don't necessarily try to bash it, but it's not where I would choose to invest money. Too volatile for me. It's way too volatile for my clients, and so it's not, frankly, of interest. But people in that world are very enthusiastic, many of them, and Sam Bankman-Fried was sort of one of the poster children, I guess, of the crypto world, and so everything collapsed. It went from whatever it was worth, 16 billion to zero in very, very short order. And no one saw it coming, apparently. It just happened very quickly, and billions of dollars just evaporated overnight. There apparently was a hole in their financial statements. No one really knows where it came from. That unaccounted for $8 billion was not there. And as they filed for bankruptcy, I read this morning that their liabilities were $9 billion and their assets were 1/10 that, about 900 million. 9/10 of a billion compared to 9 billion. So they were leveraged. And of course, the crypto world is leveraged. And it even starts to look like now a house of cards. So I'm going to play two pieces, one from Art Cashin, who again gives a very balanced view on the crypto world and in particular FTX, and then one from Ron Insana. Ron Insana used to be a host on CNBC, and he now works for another company, but they had him back to do a piece on this, and it was very well done. And so it's done by Tyler Matheson. So I think you'd find this interesting, and so I'll play both pieces for you. First, I'll let you listen to what Art Cashin says, and then Tyler Matheson interviewing Ron Insana.
Art, wow. I mean, so much has happened. Let's start with crypto, I guess. I'd love to know sort of how you think, or if you've been impressed with the way in which the broader market has absorbed the FTX story.
Yeah, well, right now, Carl, it's more kind of a soft contagion rather than a direct. It's not intermingling of things like counterparty risk. It's more that the people in the cryptocurrencies, if they need money, if they need funds to shore things up, they probably can't do it in a very weak Bitcoin environment. You saw that this morning. We looked like we were going to extend the equity rally, and then when the bankruptcy announcement came out and Bitcoin went down to 16,000, that pulled the legs out from under the equity market. So it has interrupted and maybe even detoured that move toward the 200-day moving average. The S&P looked like it was going to try for 4,000, 40, 50, somewhere around there. So this is an ongoing story. We're going to have to wait and we turn over each new leaf here and see who owes what to whom. It seems from afar that people are looking at something and saying, well, that's my dollar, your dollar, and our dollar. And the language was confusing enough. So I think if we could magically resolve the cryptocurrency thing, we could see if we would have one more try at the upside. I think around the 15th next week, we're having a minor cycle change. So I think we need to start the rally before then or run into some stuttering problems.
Okay, so I think that was helpful. And the next one will be from Tyler Matheson interviewing Ron Insana. I'm going to play the whole piece on this. It's almost 5 minutes, but everything he said I thought was helpful to give perspective and context. And so if you're interested in this area, I think you will find Ron Insana's comments enlightening.
Ron, always good to see you.
Same, Tyler.
What would have been the telltales here with FTX and Bankman-Fried that would have told people that this was one that was on thin ice?
I think all of it. I mean, there's nothing about the crypto market, as I wrote yesterday, that didn't, in many ways, reek of a very famous line from Gertrude Stein. There is no there. This is one of the largest speculative bubbles I've seen in my career or have studied over the course of the last 38 years. And look, there are a lot of apologists for crypto out there right now saying that this is a cleansing process and that DeFi is going to overtake CeFi, and that this was an error in centralized finance and this was just a one-off. The whole thing is nonsense. There is no there. These are fake tokens. This is fake currency. This is not real money. It's not backed by anything. And from what we're reading, if you read between the lines, there may in this case have been at least allegedly misappropriation of funds, rather sizable amounts of money, in fact, that just makes this another scandal, another scam in a long series of them that we've seen on Wall Street and even going back throughout market history.
I'm a little slow on this kind of stuff, Ron. What makes the U.S. dollar basically a fiat currency, different in quality from a Bitcoin? In other words,
well, I think there are a lot of things. You have a $20 trillion economy behind the dollar. You have interest-bearing securities in which you can put your dollars and park them with a relative degree of safety. The U.S. is still a very highly rated credit, even despite our debt to GDP levels and other issues that we have. The full faith in credit is behind the dollar. The Federal Reserve stands behind the dollar, and I know there are people who believe that that's part of the problem in the DeFi world. But look, it's a real thing. The dollar comprises about 65% or more of global trade. It's used in 95% of foreign exchange transactions around the world. It is a reserve currency. Bitcoin is not. Bitcoin doesn't exist in any way, shape, or form outside, I think, at least in my humble but seasoned opinion, in the minds of those who created it.
I'm going to push back on this a little bit, Ron. In the sense that you do have things like the USD, which is a stable coin. It is tied to the dollar. It is part of the centralized finance discussion that you're touching on. We have had a number of people come on our air this week. Michael Saylor, we just showed that string of sound, was a good example at MicroStrategy, talking about this difference between centralized and decentralized tokens, and basically says, Bitcoin, they were in a dysfunctional relationship with for Bitcoin enthusiasts, a dysfunctional relationship with the broader cryptocurrency community. So there definitely seems to be this major coming to roost moment, if you will, for the broader space. But as long as you do have the Michael Saylors and the Mike Novogratzes and the Squares and all of these other companies of the world that do believe in something like Bitcoin, there's going to be a market for it, and there's a limited supply, which I think also adds to that. So this idea that the entire thing is a Ponzi scheme or a house of cards or the biggest bubble you've ever seen, I'm going to push back on that a little bit. I think there's a bubble here, but I think it's not all equal, potentially.
Well, listen, first of all, a lot of the people who support Bitcoin have failed miserably in other endeavors, either blown up their hedge funds, or in the case of Michael Saylor, Morgan, I would recommend you go back and look at his company, MicroStrategy, in the 1990s and see what the history of that is. And he's put Bitcoin on the balance sheet of a company and effectively counted it as cash when it's not cash. And so, I would discount his perspective in particular entirely. And look, I think there is no use case for these currencies. I have yet to see Bitcoin.
But there is a use case for some of the underlying technology, right, Ron? Like blockchain.
Blockchain technology, absolutely. For payment systems that are becoming less expensive, friction-free, more transparent, and more safe, absolutely. But the cryptocurrency part's the overlay. The underlying blockchain technology is the part that's important. So where I see a lot of these people coming out of the woodwork, I never saw this coming, or Bitcoin is different than FTX or what resides on FTX. I just think that's nonsense. I mean, we've done this a million times in the past, whether it's tulip bulbs, whether it's railroad bonds, whether it's electronics companies, or whether it's bad internet companies that, the underlying internet, of course, was important, but a lot of the players like CMGI and others simply disappeared because they had no functional use case. I think that's the same story here.
Okay, now the FTX and the collapse of FTX is not Bitcoin. It's not other cryptocurrencies. It is an exchange. So Ron Insana makes that distinction, that there are some aspects that are positive in the crypto world. He points those out, and then as well as obviously some problems. But this, you can see the trajectory, this kind of, I think really fueled the collapse because as the crypto market and Bitcoin in this case continue to decline and really almost collapse, you could say that it clearly has an effect in that world, and people become worth less and less, and then panic sets in, and then panic selling. There's lesser buyers than sellers, and but anyway, this gives a perspective. This shows that Bitcoin went from $65,000. And I took this picture, I think it was this morning. I took this picture off of Yahoo. It is now 15,000, down from 65. That is a loss of over 75%, about 76% in about a year. That's massive. I'm not invested in that. I've never recommended people invest in that. But to be honest, I feel sorry for them because, that kind of a loss is huge. And but it's, as Ron Insana said, we've seen this before. It's the Wall Street is littered with stories like this over the years, going back as far as you want to go back. And it's unfortunate, but you can see I think in my view, maybe youth, greed, arrogance, the latest craze, leverage, whatever you want to call it, definitely played into this. And the collapse of FTX is not going to be good probably for the crypto world or in particular Bitcoin. So, but we'll see where it goes. It was interesting that back in the spring, I don't remember when it was, I want to say maybe it was March or April, I played a piece from Scott Minerd, and again, just about everything Scott Minerd says usually comes true. At that time, Bitcoin was around 30,000. And he made a prediction. He said, it would not surprise me to see Bitcoin go all the way down to $8,000. Well, I thought, wow, that's a long ways from 30. It already felt like it came a long ways down from 65. And here he's saying 8. And now I'm thinking, maybe he's right. Maybe it will be 10 or 8 or something, because it feels like there's more to go. Okay, so this chart illustrates the decline over the last year, approximately, of Bitcoin. Next, I'll give you the flow of funds report. It's interesting that with the being a positive week for the market in general, some positive days, some negative, but in general positive, it's interesting that there were outflows in the conventional equity funds of $19.1 billion and out of conventional bond funds of $6.6 billion. Interesting. Money market funds had inflows of $4.6 billion. It tells you, and of course this is a composite number, but it tells you that in general, I think there is still cautiousness out there. This is not dissimilar from the flow of funds report But when I saw it, I thought of the flow of funds report. It shows, this line graphs the deposits at commercial banks. Deposits. As deposits rise, and you can see during the pandemic, a lot of fear there and an increase in bank deposits. After that initial spurt went away, later on, then, not so much bank deposits. Look at where that's gone. Incredible. The amount of money that is being pulled out of commercial banks. Where is it going? This chart doesn't tell us. But there is a flow of money going out of commercial banks. The good news is I found it. The bad news is it's full of Bitcoins. Thank you for watching. If you have questions or comments, leave them in the comments section below. Again, thank you for watching.